Well, welcome back to the Velocity channel, the bridge to your financial freedom. In today's video, we're going to be comparing velocity banking and traditional banking. Those methods are very different many times, and it's going to help you make an informed decision on which approach is best for your financial goals. So without further ado, let's go ahead and like, share, and subscribe, and then let's dive in. So part one, right? Traditional banking. Traditional banking involves using conventional methods to manage your finances, such as savings accounts, checking accounts, and loans. We're actually going to do a demonstration of how that can be harmful to you in just a little bit. But some of the advantages of traditional banking include familiarity, right? Well, most people are already familiar with traditional banking systems and how they work, so they're a little more comfortable with that. Accessibility, right? Traditional banks are widespread and easily accessible with physical branches and ATMs available in most areas, right? There's also security that you got to be concerned about, right? Traditional banks are regulated, insured, providing a sense of security for your money. However, traditional banking also has some drawbacks, doesn't it? Limited growth. Like savings accounts, they often have low interest rates, which can limit your financial growth. They have debt accumulation. Traditional loans can lead to long-term debt accumulation due to high interest rates and extended repayment periods. Now, what is a traditional banking method that we can give you an example of and show you how that can be a little more harmful than velocity banking? Well, without further ado, let's get into that right now. Now, we're going to look at this chart here and from a traditional banking perspective. Traditional banking is going to give you, like we already covered, checking account, right? Savings account. It's going to give you some loans, right? Say a mortgage, right? Some car loan. Also, lines of credit, right? They do have personal lines of credit, business lines of credit. We have credit cards as well as the other ones. But this is what I want you to know. Traditional banking says you have to do this to your bank account. Right? Watch this. You have to segment your income. That's what traditional banking says that you have to do. The thing about, and this is going to be a spoiler alert, the thing about velocity banking is it's not another form of banking. It is banking within banking, because you're doing velocity banking in these traditional methods, within these traditional tools, which is the savings account, which is the checking account, which is the line, which is the loan. And it's actually leveraging all of these accounts, making sure that your interest is canceled as much as possible by utilizing, if you have one, a line of credit. Now, CJ, do you need a line of credit? No, you don't need a line of credit to implement and execute the velocity banking strategy in an excellent way. Why? Because it's all about taking this $15,000, right, that you have in your line of credit and chunking the principal. Remember the chunking method? There you go. It's all about when you're paying off your bills. It's all about when you're paying your loans. Because the further you go waiting on that payment and you're missing out on putting that massive amount of line of credit towards that principal, the more you're going to get charged in interest. You know why? Because you're getting charged daily. You're getting charged monthly. You're getting charged whatever the case may be. But if you cut it off at the pass, and you put this line of credit to use instead of having that money stay there or parking that money there, right? What you're going to do is you're going to take maybe $12,000, maybe $10,000, hey, even $8,000, put it towards the principal amount of this loan. And this could be a mortgage. This could be a car loan, any loan, personal loan, right? Payday loan. You put it towards the principal and it takes out that interest that you would have been paying had you not put that $8,000, that $10,000, that $12,000 towards the principal amount. Why? Because the interest is the parasite and the principal is the host. And I'll say that one more time. Interest is the parasite and the principal is the host. Meaning the bigger the principal, well, the bigger the amount you're going to pay, right? But the smaller the principal, the smaller amount you're going to pay. Now, in the case of the mortgage or those amortized loans, of course, you're going to have a continual scheduled payment. It doesn't matter how much you pay, right? You're going to have that $1,200 a month, but the amount that's going to the interest is going to be less than the amount that goes to the principal as you continue to pay correctly, right? That is making sure that you have, whether this is coming from your line of credit or from your checking account or from your savings account. What we're doing is we are utilizing all of these methods. And I want to give a shout out to David who said, hey man, don't forget the IRAs, right? Don't forget the IRAs. And that's true. We can't forget the IRAs. We can't forget those retirement accounts because you can utilize those retirement accounts in the velocity banking method as well. And so we just want to let you know about that. So one more time, you take your line of credit, or if that 15K is inside of your checking account, let's use that. And we're going to use that to pay down the principal amount for our mortgage or for our personal loans, for our payday loans, or for our car loans, right? Or for our relative loans. Okay, hope not. But we're going to pay that amount towards the principal so that that interest is not as much as if we wouldn't have chunked that principal down with that 15K. Because when we put 15K towards the 200K, that's $185,000. That 6% is going to eat off of, all right, that 185,000 versus the 200,000. Now, get with your lender and make sure they're not sneaking it up on you, because there's different types of lenders. I'll just say it like that. And there's different types of banks. And we are working on a card, right? And I do thank you for that comment. I did read it. And we are working on a card so that you can utilize to implement in your business. And it'll actually be, and I can't say too much about it now, folks, but we are working on a card for you, for the Velocity Bankers, for our members, for our subscribers right here on this channel. So pay attention to that pretty soon. But that's what we want to do. We want to stop the income segregation. Come on now. We want to stop the income segregation, and we want to make sure that we're consolidating and eliminating. So we consolidate to eliminate, meaning as the income comes in and the expenses go out, we want to make sure at the same time that we are paying off a tool that is going to assist us in eliminating these loans. And one of those tools just happens to be the line of credit. Okay, that's right. When that $5,000 gets deposited inside of that line of credit and the $3,000 goes out in expenses, let's say, that $2,000 that's left behind is paying down that line of credit, paying down that credit card, paying down that business line of credit, paying it down because of the way we allocate our finances. So it's not just about how much you make, right? It's how much you keep and where it goes. And so you see that it's really not a competition at all, traditional banking versus velocity banking. It's not at all. What it is it's a leverage. Velocity banking you can utilize inside of traditional banking systems. You can even utilize velocity banking in non-traditional systems like the First-Lien HELOC, right? Oh my goodness, guys. First Savings Bank. I gotta let you know, these guys know about integrated cash sweep systems, integrated checking accounts with the sweep feature. You ever heard of that? Oh, it's beautiful. Hey, listen, we got the links below, and I just want you to know that we partnered with them, right? We made sure that we made a connection with them for you, and people are taking advantage of that left and right. So if you have any questions, if you have any concerns, you need to talk it over, you need a customized velocity banking map for yourself, you need a tool for yourself, just let us know. We've got that calendar link right now. We are not busy for you. We're not too busy for you. We'll be there to help you each and every step of the way. So listen, I just want you to know, let's go over it just one more time, folks. Make sure that you are getting this money that you've worked for it really hard, right? You earned it, right? Let's make sure it works for us. Let's make sure that these soldiers work for us. So let's put these 15,000 soldiers towards this enemy, right? The principal. And as you're continuing to pay it month after month, make sure that when this gets filled back up, and it will, because $2,000 is your cash flow, right? And you don't have to worry about your minimum monthly payment, because you're paying $5,000 each month in, let's say. As that fills back up, as that line of credit fills back up, what are you going to do? You're going to hammer this principle again. And it doesn't matter if you have a line of credit or even just a checking account or even your retirement account. You got any questions? Don't hesitate. Let's get back into the video. Velocity banking, right? Velocity banking is an alternative approach to managing your finances. That's all it is, right? It's all about leverage. So you can actually call it leverage banking as well. What it does is it focuses on using lines of credit to pay off debts more quickly and efficiently. However, you don't need a line of credit to do velocity banking. Now, some of the benefits of velocity banking include faster debt payoff, as many of you know, right? By leveraging those lines of credit, you can eliminate those debts more quickly, right? Saving on those interest payments. You also have increased cash flow as you pay off your debts. Your cash flow, what does it do? Increases, allowing you to invest in other financial opportunities. However, velocity banking also has its challenges. So let me show you what some of the challenges are. Complexity, right? The concept of velocity banking, it can be difficult for many people to understand, right? And it also requires some discipline, doesn't it? Just a little bit more. See, velocity banking requires strict financial discipline and budgeting or money allocation plans to be effective. So all in all, if you're not responsible, then perhaps velocity banking, you need some tutors, right? Maybe you need a little help in introducing velocity banking to you, and that's what we are all about. Maybe you need some tools to help you with the velocity banking concept. That's what we're all about, all right? Now listen, in conclusion, both traditional and velocity banking methods have their pros and their cons. The cons for the velocity banking method would be those that aren't responsible, right? And those who are, they lack discipline, right? They need help. I'm not saying that you can't do it. I'm just saying, hey, we got to get out of that mindset of, man, the traditional banking method, I have to pay my lender thousands and thousands of dollars and not question their tactics. We don't want that for you, right? So this is what we want to do, right? We want to let you know it's essential to evaluate your financial goals, your risk tolerance, and your personal preferences when you're deciding which approach is best for you. Now, if you're interested in learning more about velocity banking and how it can help you achieve financial freedom, this is the channel for it, right? And also, we have a schedule that you can get on and make sure that you check out each and every video that we talk about velocity banking in. Okay, now, folks, please like, share, and subscribe because people all around the world need to know about the velocity banking method and how it can not only help their economy, but it can help the world's economy. God bless, and you guys have a great night.